Hey guys, Tony Denaro here. Welcome back to the channel. In this video, I'm going to be explaining to you what is the debt to equity ratio, one of the foundations of analyzing a company if you're interested in value investing. Let's get right into it. Okay guys, debt to equity ratio. This is a very important topic, so I hope you have a couple minutes to spare to watch this video and let this all sink in. What is debt to equity ratio? How is it calculated? Where can you find it? And more importantly, how does Wall Street view debt to equity ratio in determining if a stock is a good investment or what price to pay for a stock? As a company is growing, they usually have capital needs, and those capital needs come from two basic sources, either equity or debt. Equity, as you're probably aware, is when a company issues stock, either through an IPO or a secondary offering. Companies can also take on debt to fuel their capital needs to fund their business. That's what we're going to be talking about today. A couple of thoughts to get us started here. Debt is not necessarily a bad thing. It is the amount of debt that a company takes on relative to equity and other things that sometimes can become a problem. Imagine debt like a boat. If you are a company with a small amount of debt and there is an iceberg up ahead, you can turn nimbly and quickly and avoid that iceberg. If you are a large cruise liner or a tanker and you are just loaded down with debt and you see that iceberg up ahead, you may not have time to correct before you hit that iceberg. So value investors, analysts, and Wall Street in general prefer companies that have a low debt to equity ratio. Also, it is probably worth mentioning that debt to equity ratios from industry to industry can vary. So keep that in mind as you're comparing companies. For example, if you were looking at a textile company, that industry's debt to equity ratio, what is norm there, might be very different from the norm in the tech industry. The debt to equity ratio is a measure of the company's financial risk. This is why it is critical for you guys to understand what it is, and it is very easy to figure out. I'm going to show you exactly how to do that with one or two quick examples. But first, just so you know what we're looking at, here is the formula. It is total debt divided by total shareholders' equity. Now, if you just Google this, you might find some very simplistic ways to calculate this, like going to the balance sheet and taking total liabilities and dividing it by total shareholders' equity. But when you look at total liabilities, sometimes there are things in there that are not really debt. So we're going to be using a more narrow definition when we look at this formula. For this video, we're going to categorize debt for our formula as any short-term borrowings plus any long-term debt. We're going to look at a couple of real-life examples because I want you guys to be able to do this yourself, and you should for any stock that you're planning on holding more than a couple days. And then at the end, we're going to wrap up and talk about what Wall Street and what lenders think when the debt to equity ratio is whack. It is March 2023. The first company that we are going to be looking at is Chevron. This is a free tool that you guys can use, stockanalysis.com. You'd go over to financials, then you go over to ratios. You don't even need to do any math, but I'm going to show you how they get to this number. Scroll down, and it has the debt to equity ratio right here. The current debt to equity ratio is 0.15 for Chevron. Next, let's look at Apple on stockanalysis.com. Click on the tab that says financials, go to ratios, scroll down. Debt to equity ratio for Apple is 1.96. For a safe investment, for a value investment, we want a low debt to equity ratio. The lower the better. So between these two, Chevron with 0.15 and Apple with 1.96. If the only thing that we were looking at, and nobody would really do this, but I'm just saying, if the only thing we were looking at to compare these two companies was the debt to equity ratio, Chevron would be the smarter play. Let's look at one other popular company, AMC Entertainment. We'll go to financials. We will go to ratios, scroll down, and you can see that there is a negative debt to equity ratio. This is a very bad thing. You do not want to have a negative debt to equity ratio. Let's look at exactly where this number comes from. You only got to look at a couple spots on the balance sheet, and then we're going to wrap up talking about why this number is so important to Wall Street and analysts when they determine what they're willing to pay for the price of a company's stock. Okay, so let's say you didn't have a tool like this available and you wanted to go out and get this number the old-fashioned way. For Apple, you would go over to the balance sheet, scroll down to the liabilities section, find the long-term debt here. This is in millions, so we have 98,959 million. And then we are going to divide that number by the shareholders' equity, 98,959 divided by 50 672 gives us the 1.96 if we round up. If we want to do the same thing for Chevron to validate this debt to equity ratio of 0.15, again, go over to the balance sheet, get your total debt. Here we have 23,339 divided by the shareholders equity, which is 159,282, and we get rounded up 0.15. We're going to talk about that third example because it is one that you see in a lot of different companies, the negative debt to equity ratio. But first, let's talk about these two good examples, Chevron and Apple. When you have a low debt to equity ratio, and generally I would say that anything under 2 is considered low. Anything under 0.5 is probably what we'd call 5-star investment. When you have a low debt to equity ratio, the company is in good financial health. When the debt to equity ratio starts getting really, really high, especially compared to its peers in an industry, a company starts looking to be a risky investment to Wall Street, to lenders, and to most investors who know to look for this stuff. A very high debt to equity ratio can also make it difficult for a company to get additional loans if it needs to fund its business with new capital. For those reasons, value investors are typically looking for companies that have a low debt to equity ratio. When we look at companies, and there are many of them that have negative debt to equity ratios, like this example here where it is negative 3.82, how does that happen? If we go over to the balance sheet and look at total assets, it is lower than total liabilities. When your liabilities are greater than your assets, then you get a negative shareholders equity. That throws off your debt to equity calculation and gives you a negative number. You might see it on some websites just reported as blank because they don't report a negative debt to equity ratio. And it's good to know, guys, just so you know how Wall Street and analysts look at something like this, a negative shareholders equity, that this is considered in general a high risk play, high risk of bankruptcy, high risk of not being able to get additional debt if they needed to fund the business. If you can't go get new debt to fund the business because your debt to equity ratio is whack and your operations are not funding the business, the only real other tool you have left is to issue new equity, to issue new stock. We're going to be talking about many, many more of these ratios and how to evaluate companies, how to find the best investments for your portfolio. Hopefully you got some value out of this. Hit the like if you did. If this is your first time here, don't forget to buy and hold that subscribe button. I am Tony Denaro, and I will see you on the next video.